Hello and welcome to Let's Talk Tax, the show for growth-minded CPAs and real estate pros in tax. I'm your host, Tim LeMasters. In today's episode, we're diving into the world of bonus depreciation, a topic that's been a cornerstone of tax planning for years, especially since the Tax Cuts and Jobs Acts of 2017. We'll break down what it is, how it works alongside Section 179 expensing, and what changes might be coming down the pipeline. Whether you're working with manufacturing clients or real estate investors, getting this right can mean the difference between significant tax savings or missed opportunities. Joining us today on Let's Talk Tax is shareholder and co-founder of McGuire Sponsel, Dave McGuire. Welcome, Dave.
Thanks, Tim.
How much do you love depreciation, Dave?
It's not a good question, Tim. How much am I willing to deal with it so I can pay the bills and put my kids through college? That's a different question.
I beg to differ. I feel like this is your go-to spot, man. I feel like
it's a comfort level because I know about it. It's different than loving it.
Well, we're going to get you outside your comfort zone today because I'm going to be a firing squad.
There you go.
Very rarely on here do we spend time just firing questions, but that's going to be me today. So we're really going to dig into this today because I think there's a lot of important information here. Obviously, we've got a big bill coming. Don't want to talk a ton about the big, beautiful bill, but I think it's important to know kind of some of the things that have happened, over the years and where we're looking for bonus right now as it sits and hopefully going forward. So just kind of starting off, people talk a lot about bonus depreciation, how it can benefit taxpayers. Can you give us a little background, what it is, what is eligible, kind of go through it just to get everybody understanding of it?
So bonus depreciation, it's been around, and the problem is, Tim, I've been doing this longer than bonus depreciation has been around. So I'm older than bonus depreciation if you're going through things that are older than Dave.
Okay.
The bonus depreciation came out in the end of 2001. It started really in 2002. It's a way to stimulate the economy after 9/11. Mm-hmm. So it's bounced around at different levels, but typically we're talking anywhere 30 to 100% is the typical range of bonus depreciation. It's under 168K of the code because I know people love it when I throw out numbers and letters. But what bonus depreciation amounts to is it's an acceleration of depreciation deductions into the first year. So what does that mean? Let's say you're going out, you're buying a TV. We've got a TV on the wall right there. TV costs $1,000. Well, typically you depreciate the TV, you get a little chunk of that $1,000 back every year. What bonus depreciation says is we're going to give you a large portion of it right up front. So let's say we get bonus depreciation at 50%. They say that $1,000 TV, 50% of it we're accelerating, then the other 50% you depreciate is normally over, let's say, 5 years.
Okay.
So what's eligible? Well, traditionally it's always been personal property, which is things like the TV, things like a desk, carpet in a building. Now, it's been extended to really anything with a life of 20 years or less. So that could be qualified improvement property, which is a big change from the Tax Cuts and Jobs Act back in 2017. Now, the other thing that the Tax Cuts and Jobs Act changed is it used to be back when I first started hearing about bonus back in 2001, 2002, if I went out and bought that TV had to be brand new. Now it just has to be something I'm acquiring. So it could be that you had the TV, you held it for 3 years, you took depreciation on it, then you sell it to me for $1,000. I can still take bonus depreciation on it, even though it's not a brand new TV.
Okay. So how, just moving quickly here, how does that differ from 179 expensing?
Well, remember I said bonus depreciation is an acceleration of depreciation.
Okay.
179 is a immediate expensing of an asset. So let's say I take 179. Well, if I take 179 on the TV, I write it off completely in day one. Now, the difference is, so when I'm going through that calculation, 179 comes before bonus depreciation. Now, not to get really wonky on the math, but what that means is when I'm calculating, if I've got room under my 179 expensing, I need to include assets, even if I'm going to write them off 100% with bonus. So understanding that interplay can be critical for businesses to get it right. The other thing is not everybody can use 179.
Okay.
179 is limited to assets that are being held for a business use or something else, not just for investment. So let's say McGuire Sponsel. Let's say we go out and we buy a cubicle. Now, not making tax advice here, but let's say McGuire Sponsel goes out and buys a cubicle. Most likely we can 179 it, because we're holding that for production of income. Now, on the flip side, I go out and I buy a rental house, and that rental house has cabinetry in it, personal property. I can't take 179 on the rental house because I'm holding that for investment purposes, not for production of income. So it's important that we understand where those things interplay, because that can make a huge difference.
We're kind of crossing off a couple of my questions here, but I want to ask them anyway. So can you really get in depth on when it would be more beneficial to use one or the other?
Yeah.
I know you kind of explained it a little bit, but maybe go into some more detail there.
Well, we only scratched the surface. There's a lot of reasons. So take 179, for example. 179, let's start there. Why is it more beneficial? Well, back when I was first starting my career and I was first learning about a lot of these things, I was with somebody and they referred to 179 as kind of the sniper versus bonus depreciation as a shotgun. So when you're using bonus depreciation, you have to encompass everything that qualifies in that category. So say I buy a TV, I buy a desk, I buy a computer, and I buy like 5 or 6 items that are all 5-year personal property in 1 year. I either have to elect bonus depreciation on all 5-year property or I elect out of it. So it's all or nothing. So let's say I buy $1 million worth of bonus eligible property. I can either take 100% bonus on it we'll use 100% bonus for math because it makes it easy. I write off the full $1 million. But if I'm sitting there and I only got $500,000 worth of taxable income, I just push myself into a loss. Mm-hmm. On the other hand, 179, I can pick and choose items. So I can say, I want to take it on the TV, but I don't want to take it on the desk. So I can pick and choose items that I want to use. So it's a very good planning tool as we're trying to manage taxable income for somebody, because especially if we're working with a pass-through business, let's say you and I own a pass-through business, and we've got $1 million worth of income. We're splitting it 50-50. Well, we might not want to push our income all the way down to zero, because then we're taking deductions against our lower marginal tax rates. So we might actually opt out a bonus, then choose 179 to push our income. Maybe we want our income to be $300,000, because then we're getting that big deduction against the between that $300,000 and that $500,000. So we only want $400,000 worth of deductions. We might then opt out a bonus. We got $1 million worth of deductions, so we take, say, $200,000 worth of straight line depreciation. Then we still got another $200,000 worth of income we want to offset. So we pick and choose the 179 there. So there's ways we can use 179 that are more beneficial. Now, on the other hand, there are times I can't use it.
Yeah.
Or let's say I'm a business and same business. You go, Dave, that's fine. We can pick and choose, but I want to just take as much as we can, push ourselves into a loss, and then carry forward that loss into future years. 179 can't push you into a loss position. Those are some of the ways, but then it goes a little bit deeper. Let's say we have a manufacturing business and we're replacing the roof. Well, most people know that a roof is a 39-year asset. So it's not eligible for that qualified improvement property. It's not eligible for anything else. But a roof replacement is eligible for 179. So we might choose to use our 179 against the roof. So depending on the situation, we need to be aware of what's 179 eligible, what's not. Now, I know you said we were not going to talk too much about the big, beautiful bill. When we get into that, there's going to be some other areas based on the way the legislation is currently written that's going to make it actually really critical in 2025, but we'll hold off on that till you get to that part.
Okay.
And then I'll bring that up as a surprise.
Okay.
Because I know you're really interested in getting into that policy.
I'm so excited, Dave. Can't wait. I guess to me, I feel like it's really important for companies to get this straight. Mm-hmm. So how do you navigate that?
Well, it's important that you understand. So I was sitting with a client about a month ago, because we're sitting here, we're past tax season 2025. So I won't use an exact date, but we'll say when we talk about the big, beautiful bill, it's gone through the House. Senate hasn't accepted it or rejected it yet. So that gives people a little bit of a timestamp as to when we're talking. Going back to tax season, sit with a CPA firm, and they sent me something to review. And they said, well, with bonus depreciation leveraging down being only 40%, we've asked all of our staff people to really pay more attention, or 60%, in 2024. So we've asked all our staff people to pay more attention to 179. They said, look at this return. Pull out a return. And they had $2 million worth of 179 eligible costs. Now, you can only take about $1 million worth of 179 index for inflation, but of that $2 million, they had a roof replacement, they had an HVAC replacement, and they had a whole bunch of personal property. Well, the roof replacement and the HVAC replacement are 179 eligible, but they're not bonus eligible. However, they were the first things that business did in 2024. So the staff person checked the 179 box next to the all the equipment because that's what they saw first. So when they did that, they took that against $1 million worth of equipment. Well, that $1 million worth of equipment would have gotten 60% bonus last year. So they would have written off $600,000. But then by the time they got to the roof and the HVAC, they didn't have any 179 left. So that got capitalized as 39 year, and then they got a very minimal deduction. So what ended up happening is I looked at the return and I said, wait a second, let's switch the 179 over to the roof and the HVAC. By doing that, they wrote off the roof and the HVAC. That got them $1 million deduction. Plus, then they wrote off the equipment over bonus, so they got 600 plus another 20% on the 400. So they got about 68% on that. So that's 680,000. So they ended up going from basically about $1 million deduction to a $1.7 million deduction just by knowing which boxes to click on the 179. So it's critical that people understand that interplay, because by clicking on the wrong box, often you undercut what you can take. So knowing where these things come into play can be critical.
Okay, that makes sense. And since you've been doing this longer than I would say probably 40% of our firm's been alive, can you give some examples of when doing this right or wrong really mattered over your tenure?
Well, that made me feel really old. 40% of the firm is, I've been doing it longer than they've been alive. I mean, I know it's true. I think actually that might be a little light. I think it might be 50%.
All right, we're just coming to reality, Dave.
Hey. But that's, I think the example I just gave where somebody understanding that can be critical.
Yeah.
Now, we also see people that they don't understand the rules. They don't dive into it. We had a client recently that they were sitting there and they opted out of bonus because of 163J. I know that's not the topic of the conversation today. What's 163J? Once again, numbers and letters.
Yeah.
That's the interest limitation. So by opting out of the interest limitation, they elected to be a real property trader business, which gives them the ability to take more interest. Well, they didn't pay attention to the fact that they were planning on actually expanding and doing a whole bunch of renovations to their existing manufacturing plants a year or two later, or some of their existing facilities a year or two later. Well, by electing the real property trader business, they locked themselves out of taking bonus on QIP. So they elected this ability to be claimed as a real property trader business in order to maximize their interest deduction, which amounted to about $50,000 a year. But by doing that, they left all the bonus depreciation on the table, which amounted to about $1 million the year in question. So having these conversations before making those elections can be critical, but also knowing how these things interplay can also be important.
So let's rewind a little bit.
Mm-hmm.
Let's look at how bonus changed under TCJA in 2017. I'm going to give you two questions. Hopefully you can hold these together. So let's look at it, how it changed under the TCJA, and then where it stands currently.
Yeah. So bonus depreciation changed in a couple ways. First thing, and I mentioned it earlier, but I think it's important to reiterate. When bonus depreciation first came out, they had what they call the first use test, which means it basically had to be new to the taxpayer. So if you went out, we used the TV as an example before, but I'll use it again because it's the only thing on the wall. We're not going to worry about bonus depreciation on mugs.
Okay.
So I need something to point to, so I'll point to the TV.
Well, we got plants in the room too, but keep going.
Once again, well, plants have different rules, Tim.
All right,
you don't want me to go there. Plants have different rules.
I'm sorry.
We take the TV. So prior to the TCJA, that TV had to be brand new in order to take bonus depreciation on it. Mm-hmm. They got rid of that test. That opened up a lot of things. Because now, let's say you go out and you buy a warehouse. You spend $10 million in the warehouse. You go, Dave, there's not much personal property in here. But 30% of that $10 million you spent is related to the parking lot. That's $3 million. Now, because they changed the rules under the TCJA to allow used property, now we can bonus out that whole parking lot at $3 million. Get you a big deduction the year you buy the property. So the main thing there is that they moved it to include used property. The other thing that they did, Tim, is they increased it to 100%, but only for 5 years. So they said, okay, 2018, 2019, 2020, 2021, 2022, you get a 100% bonus. Then we start leveraging down at 20% for a year.
Phases out, yeah.
Yeah, so we're in that phase out mode now.
Where are we at 40% now?
Yeah, 2025, we're at 40%. So we start seeing it drop down.
Yeah.
Now, that was expected, and that's really been the way they've written most bonus depreciation regulations in the past, is it never hits a cliff, always kind of fades out and slowly drops down. So we're in that phase-out mode, and there's a lot of people pushing to really increase it, but that's the other way it changed.
In the bill, it looks like 100% bonus is coming back, currently as it sits.
But
still a phase-out period at some point.
Actually, no. That's actually where it changes.
Okay.
In the Big Beautiful Bill, there's no phase out.
Okay, good.
It hits a cliff in 2030, at the end of 2030. So property placed in service 1/1/2031, no bonus. It actually changes the definition of bonus to be up until the end of 2030.
But even if there's no bonus, there's still opportunity.
There's still opportunity. Well, and they changed 179.
Yeah.
So let's jump into that some of the changes under the Big Beautiful Bill for a second.
Yep. Sounds good.
So under the Big Beautiful Bill, we see that bonus changes, and we get that 100% back. Now, if you look at most changes under the Big Beautiful Bill, they're retroactive to 1/1/2025. Bonus is the one exception. Bonus is retroactive to property acquired by 1/20/2025. Why 1/20? The president in
inauguration.
It's inauguration. It's
Come on,
exactly
Dave.
right.
Got to take credit for that.
Well, it's interesting though that had the president not pushed it for inauguration, it might have actually been retroactive to the beginning of the year. But now we got 20 days window. But what's critical with bonus is we look at that. It's based on an acquisition date, subject to binding contracts.
Mm-hmm.
So let's say you're building a facility, Tim. You're building a facility. You start building it in 2024, right?
Mm-hmm.
So you put in the parking lot in 2024. You build the walls in 2024. Then early 2025, you start building out the interior. So you got the drywall up in January. And then in February, you put in the carpet, et cetera. Well, when we go to look at it, if the bill passes the way it's written, and you capitalize that building in, say, May of 2025, when we go look at it, the parking lot, you paid for that parking lot in 2024. So the parking lot, actually, with the capitalization in 2025, will end up getting 40% bonus. But then you paid for the carpet in February 2025 after that 1/20/2025 date. So then the carpet will get 100%. So it's going to be critical to look at that date because we're still going to see a lot of assets
That's going to be fun.
getting 40%.
Mm-hmm.
That's very similar to what happened with the TCJA. You were asking about the TCJA. In the TCJA, we had it was based on the date of the bill. I think it was September
27th.
Exactly.
Yeah. Okay.
You know, I'm glad you pointed out because I had actually forgotten the exact date.
Well,
so thank you, Tim.
No problem. Yeah.
The
2017, if you want to know.
yeah.
Okay.
So when we look at it, that's going to apply. But there's another change in the bill in the Big Beautiful Bill that's important. Remember, we talked about 179 a second ago. Well, 179 now gets increased to 2.5 million with a $4 million phase out. And the 179, it does not have the same binding contract restrictions. 179 just goes to property placed in service after 1/1/2025. So it's actually going to be critical that companies balance if the Big Beautiful Bill passes in its current form, which as we're sitting here is still a big question. Companies are going to want to balance that 179 versus bonus again in 2025, even though they've got 100% bonus, because if they've got assets they started construction on before that 120 date that they place in service after, they might be subject to a lower bonus amount, but the full 179. So knowing where that critical time frame is could be critical again in 2025, even if we get 100% bonus.
Well, what if I buy a building in, let's call it December of 24, but I didn't place it in service until February of 25?
Well, my guess is you bought it in 24. If you didn't place it in service, it's probably because you're doing some renovations or getting it ready. So same thing would hold true. It's now where the 179 would be eligible on that purchase building, because 179 does affect some purchase property. So, but not all. It's different than bonus. Parking lot probably doesn't qualify, and some other things. But then same thing would hold true. We'd want to balance that 179 with the bonus, and there might be some property in your renovation qualify for bonus. We'll take that first. But then we're going to want to make sure that we take the 179 on the assets that qualify for that first. I'm actually dealing with a client right now. If this bill passes the way it is, most of their construction was actually done in 24, but they finished the construction in 25, which means if this bill passes the way it is, they're going to be much more interested in the 179 portion than the bonus depreciation portion because they finished it in, I think they finished the construction in February, about a $2 million renovation.
Okay. Is there any reason someone would elect out of bonus?
Sure. We actually see it quite a bit.
Okay.
I'd say, once again, it goes back to tax rates. So I know anybody listening to this is probably somebody that's relatively savvy on tax. Otherwise, they would have shut it off a long time ago when I started shooting out numbers and letters.
I shut it off about 10 minutes ago, so no worries.
Hey, it happens. Trust me. As a dad of 6 daughters, I get shut off all the time, and I just start talking, and the kids all tell me I'm talking to myself. So I'm used to it. But if we sit there and we look at it, why would somebody choose? Well, it's marginal tax rates. Let's say I don't want to push myself into a loss because, as we all know, if I make, let's say, I wish, but let's say I make $5 million a year. Well, that top tax rate I'm paying on that top income, that I'm paying at, let's say, 7%. But when I'm paying on that last few $100,000, I'm not paying that same amount. So if I'm sitting there and I've got $10 million worth of assets that I can take bonus on, I may not want to take all of it because then I'm taking some of my deductions against a negligible tax rate. I want to save all my deductions and take them against that top tax rate. We could also be minimizing it for other reasons related to, like I said, the 163J limitation. It could be that I'm subject to AMT. I may have to be using ADS lives or alternative depreciation. There's a lot of reasons people might look to do it. The important thing for people to note, though, is keep in mind that that's an irrevocable election. What do I mean by that? Let's say in 2024, you own a business, and you go out and you buy a whole bunch of equipment. You go, in 2024, I don't need this deduction, so I'm going to elect out a bonus. Then in 2026, you come in and go, hey, Dave, I need those deductions now. Can you go do a cost seg study on the building I bought in 2024, find all those depreciation deductions, and accelerate them into my 2026, because, as you know, we can do a change in accounting method. Well, the problem is I can't take bonus depreciation on it because you elected out of it in 24, so I can't revoke that election in 2026. It's irrevocable. So whenever we're making those decisions about electing in or out of bonus, whether to elect the real property trade or business under 163J or something else, we want to look a couple of years into the future to see if that's going to backfire on me if I make the wrong election today.
Okay. Dave, it's been a lot of great information. It's amazing how time flies when you're having so much fun talking about 179 and bonus. But we are out of time, and I think we could probably spend another hour on this, just knowing kind of where you sit with it and all the information that comes along. And I know you spend a lot of time on calls with our CPA relationships, just walking through this and constantly giving out your cell phone because I think it's important for them to understand kind of how to navigate this. But I really appreciate it. Thank you for taking time to tune in today. You can subscribe to the Let's Talk Tax podcast on YouTube and follow us on Spotify or Apple Podcast or whatever you listen. In addition, today's show notes and links to more about the episode can be found online at McGuireSponsel.com/Let's Talk Tax Podcast. We'll see you next week. Thanks, everyone.